Hello and welcome back to my channel. Today we're going to continue our series on underwriting guidelines for 2 to 4 unit properties. We've already covered FHA and Fannie Mae, and today we're going to focus on Freddie Mac. So why are we talking about buying 2 to 4 units? Well, it's a strategy that's gaining popularity, especially among younger homebuyers. It's called house hacking, and it's a smart way to potentially live rent-free or at least reduce your housing costs significantly. House hacking, if you're not familiar with it, is essentially buying a property and renting out parts of it to cover your mortgage. So it's especially effective with multi-unit properties. So you can buy a duplex, triplex, or fourplex, live in one unit, and then rent out the rest. This can significantly reduce your housing costs, and in some cases, you might even live in it for free. Of course, it won't always work out that way, but it's a great strategy to consider, especially in a market with limited inventory and higher interest rates. So we're breaking down the guidelines for FHA, VA, Fannie Mae, and Freddie Mac because each loan program has its own nuances. And if a loan officer tells you that you don't qualify for a duplex under Fannie Mae guidelines, for example, you might still qualify under Freddie Mac or FHA. So that's why it's crucial to understand the differences. So each loan program has different loan types, loan to value and down payment requirements, credit score requirements, rules about non-occupant co-borrowers, reserve requirements, and rules about accessory dwelling units or ADUs. They also differ in whether you can use rents to qualify for a loan, okay? So we'll be covering all these aspects in detail today. So with Freddie Mac, you can use a fixed rate mortgage or an adjustable rate mortgage with a fixed period of more than 5 years to buy a 2 to 4 unit property. You can also use the Home Possible program, which is Freddie Mac's affordable lending program. However, we're focusing on owner-occupied units today, where you live in one of the units and rent out the others. The loan-to-value ratio and down payment requirements vary depending on the number of units. For a 2-unit property, the maximum loan-to-value ratio is 85%, which translates to a minimum down payment of 15%. For a 3 to 4 unit property, the maximum loan-to-value is 80%. Meaning a minimum down payment of 20%. So if you're putting down less than 20%, you'll need to contribute at least 3% of the purchase price from your own funds. Credit scores are an important factor in approval. However, the minimum credit score is determined by an automated underwriting system. So generally, it won't go below 620, but even though the minimum credit score is 620, it's unlikely that you're actually going to get approved at a 620 if you have a high debt to income ratio. That's why understanding the differences between these programs and finding a lender who truly cares is so important. Non-occupying co-borrowers are people who won't be living in the property but will be on the loan application. They are allowed with a standard Freddie Mac loan, but not with Home Possible. So this non-occupying co-borrower would contribute their income, assets, and credit score to help you qualify for the loan. So reserve requirements are another important aspect to consider. So these are the funds that you need to have in the bank after paying your down payment and closing cost. So the automated underwriting system will determine the reserve requirements based on the risk assessment of the loan, and it's usually calculated at a certain number of months worth of your total mortgage payments. So accessory dwelling units or ADUs are also something to consider. These are detached units like a converted garage or a tiny house on the property. With Freddie Mac, you can have an ADU with a 2 or 3 unit property, but not with a 4 unit property. And with Fannie Mae, ADUs are not even permitted with multifamily properties. So finally, let's talk about using rents to qualify for the loan. You can use a percentage of the rents from the units you're not occupying as income for your debt to income ratios. Typically, this percentage is 75%. So 75% of the rental income can be used to help you qualify for a mortgage. Working with an experienced mortgage professional is crucial when you're considering house hacking. They can consult with Freddie Mac and find ways to help you secure the property that you want. And unfortunately, some lenders just may reject your application because you don't fit into their perfect borrower box. And that's why understanding the differences between these programs and finding a lender who truly cares is so important. So if you're considering house hacking, congratulations. It's a smart strategy that can help you build generational wealth. You can convert your owner-occupied units into an investment property at some point in the future, and you can start building passive real estate income. It's a fantastic way to start your real estate journey. I hope you found this video helpful. If you have any questions, feel free to ask them in the comments below or visit our website. We're here to help you build wealth and memories with real estate, okay? So remember, if you want to take a deeper dive into this topic, click on the link in the description to read the full article. Thanks again for watching, and if you're using this strategy, congratulations on making a smart move in your real estate journey. Don't forget to subscribe and hit the notification bell so you don't miss out on any future videos. See you next time.